Good evening, everyone. I welcome you all in our fourth session of capital gain topic. So I'm C. Ankit Sharma, your income tax faculty for the session. Today we will be discussing the provisions regarding depreciable asset, as we have discussed earlier, the question regarding it, slum sale provision, a special cost of acquisition provision, non-resident capital gain if they purchased Indian shares, etc. in foreign currency. And also, we would start a new topic, that is capital gain part two, exemption provisions. So I believe that you all are studying very hard to achieve the goal, and that is to become a chartered accountant as soon as possible. Before starting the class, I would like to ask that if somebody wants to discuss the provision of our last session. In our last session, we have discussed provision regarding conversion of capital asset into stock and trade, forfeiture of advance money, then compulsory acquisition, transfer of asset from a partner to a firm, and vice versa, buyback of shares, liquidation of company, and capital gain in case of depreciable assets. So these topics we have discussed in our last session, and who would be give me a summary of these provision in very short of time? Like we have only 5 or 6 or 8 minutes in which you have to give a recap of last what provision we have discussed, not in detail, just basic concept that we have discussed. Like if I want to revise that, I will revise it like this, that we have discussed the provision of advance money forfeited. In that case, if advance money forfeited before 31st March 14, so at the time of sale of that property, capital gain cost of acquisition is going to be reduced. And if it is on or after 1st April 14, then it is going to be taxable as income from other source. So this way, I would like to ask somebody who will describe the provision of last session. So who wants to give me a summary of these provision, what we have discussed in session number 3? And I guess last class, Arshada explained, and before that, I think it was Priyanshi. So anyone wants to give me the summary of last session provision? Good evening, Soumya, Miss Almaz. Good evening. Good evening, Tanu. Okay, good evening is fine. But who would like to give me a summary of provision? Anyone? Please raise your hand. So I will ask to the technical team to unmute you so you can explain the provision in a summary way. Do not hesitate. Even if you are going to explain certain provisions, even if somebody wants to explain like 2 or 3 provision summary, it would be a good attempt by you. So do not hesitate. Please come forward and try to give a summary of provision. That shows how sincere you are. Either you are revisioning the provision or not. So revision is must, I believe. So anyone is here who wants to explain the provision? So nobody is here to give me a recap of the provision. Let me do the honor myself. So in the last session, we have discussed the provisions of advance money forfeited, in which we have seen that if it is forfeited before a certain date, the capital gain calculation would be affected in the year of asset transfer. Its cost of acquisition is going to be reduced. And if it is forfeited on or after 1st April 2014, then the effect would be in income from other source. Conversion of capital asset into stock and trade, we have seen it would be amount to transfer, but its chargeability year would be different. It would be taxable in some other year, not in that year in which capital asset converted into stock and trade, but in the year in which stock and trade is going to be transferred. In that year, we are going to chargeable the capital gain as well as the PGBP income. If a partnership firm transfer an asset to the partners is going to transfer the asset to the firm or vice versa. So if partner is transferring, the book value, which is going to be recorded in the books of firm, going to be the sale consideration. If the firm is transferring the asset to the partner, in that case, FMV would be your sale consideration. Destruction of asset case was also we have discussed. In again that case, chargeability here would be different. In compulsory acquisition, there would be treatment of original compensation separately. Then we have the enhanced compensation provision separately, and there was if the reduction of the original compensation case, then we have seen that we have to recalculate the capital gain again. And if we have paid tax excess, we would be able to get the refund also. Liquidation of company, we have seen the cases in which there would be treatment in income from other source as deemed dividend and capital gain also. Buyback is having an amendment, so it's very, very important for the purpose of your examination. Even I think in this final direct tax paper, the amendment provision of buyback has been asked in the question paper. So if it is up to 30th September 24, the provision would be different. And if it is on or after 1st October 2024, the provision would be different. I have also prepared some question from this topic because it is very important for your examination. 2, 3 special question I have prepared for you. That's I am going to give you for the homework. Then we have gone for the provision of depreciable asset in section 50. In the case of depreciable asset, we have to see whether whole block of asset has been transferred or not. If the whole block of asset has been transferred, in that case, either there would be short-term capital gain or loss. But if whole block of asset does not cease to exist, in that situation, there would be only short-term capital gain if the sale consideration exceeds the opening WDV and the new asset purchased during the year. So if your sale consideration exceed these two things, then there would be short-term capital gain. And if there is short-term capital loss, that means sale consideration does not exceed these value. In that case, there would not be any applicability of capital gain provision. So we have gone through with these provision. I have given you some question also for your homework. I believe you must have tried that. But before that, let me share the thought for the day. Then we will move on further. And this is very, very beautiful thought for the day. And I believe you all must try this thing. Whatever is your goal in your life, like I believe you want to be a chartered accountant as soon as possible. That's why you are joined the course. So whenever you are doing something, please do ask this to yourself. Get into the habit of asking yourself, does this support the life I am trying to create? So if you are going to a party, if you are going to spend your time on a vacation, suppose 3 or 4 or 5 days, you should ask yourself that would this kind of my activity would support the aim, the goal I want to achieve in my life? Or exactly is it going to achieve that what I'm trying to create in my life? If you will ask this question to yourself, I believe you will save a lot of time. This question may be enlightening you that you should do this thing or you should not to do this thing. So please ask this question whenever you are going to avoid your study, whenever you're going to a vacation, whenever you are going to a function, party. So if it is that important, then you can do that. Otherwise, you have to do some sacrifice to get this goal of your life to become a chartered accountant. So now there was some question I have asked in the last class and I have given you for a homework. Let's see how many of you have solved these questions. So this is question number 1. So what is the correct answer of this question? Who will tell? Very simple question I have given you for conversion of capital asset into stock in trade. Is there any query on query portal? No. Okay. So what is the correct answer? Okay, Soumya is saying B. Shalini is saying A. Anyone else? Harshada is saying E. So conversion of capital asset into stock in trade. Okay, I have opened the sheet of answers. Okay, so that's going to help you a lot. Let me open the sheet of questions. Okay. So first question was conversion of capital asset into stock in trade will liable to capital gain tax in the previous year in which such conversion took place or the chargeability year change? Of course, the correct answer is B, because the capital gain arise due to conversion is going to be taxed in that year in which that specific asset is going to be transferred in future. And we have seen in that case, there would be PGBP income as well as capital gain income. Okay. Question number 2. What is going to be the correct answer of question number 2? Where the capital asset is converted into stock in trade, the indexation of cost of acquisition and cost of improvement shall be done till the previous year of conversion, or the previous year asset is sold shall not be done, etc. So what is the correct answer of second? The correct answer of second question is option number A, because we have actually converted that asset into stock in trade. And we assume at the time of conversion, transfer has been done. So everything we should take at a time of conversion except the chargeability here. So the correct answer would be A. Well done. Third point, where a capital asset other than certain urban agricultural land is compulsory acquired, then the capital gain shall arise in the previous year. So what is the correct answer of question number 3? Omea is saying C, Almas is saying C, Rajveer is saying B. I don't know why. Mohammad Farhan is saying C. Mrs. Shalini is saying C. The correct answer is C. We have seen that the original compensation is going to be taxable in the year in which part or full consideration is going to be received. So whether it's received in part or full, that is going to be taxable in that year. Where the entire block of the depreciable asset is transferred after 36 months, there would be what? There would be a short-term, long-term gain or loss. What is the correct answer of question number 4? It's a tricky one. So in case of depreciable asset, there would always be short-term, either gain or loss, depend upon the specific cases, because the entire block of depreciable asset is transferred. So if whole block of asset has been transferred, in that situation, there could be a short-term gain or loss. Question number 5, R owns a house property which was purchased by him on 11/5/1996 for 3 lakh. So what is the correct answer of this question number 5? Ishant is saying option B. Arshada is saying D. Anyone else? Soumya is saying B. Shalini is also saying B. Rajveer is saying B. Well done. So the correct answer is, of course, option number B is the correct answer. How we arrived at sale consideration would be 50 lakh in this case. Less, if we calculate index cost of acquisition, that would be 4 lakh into 254 upon 100. So that would be 1016000. Balance would be 3984000. So you can see this is a case of destruction of asset. So in that case, transfer year would be that year in which destruction take place. So that's why it's 254. Yes. Okay, next is 6. So what is the correct answer of question number 6, students? Arshada is saying C. Ishan is saying C. You can see it's a advance money forfeited case. So it's very simple to answer. Ram has made an agreement to purchase a building from Ravan and paid 1 lakh as advance to Mr. Ravan on 1st October 23. So in case of forfeiture, we have to see the year of forfeiture. So because advance money has been forfeited in 24-25. So that would be the case of income from other source because it has been forfeited on or after 1st April 2014. Well done. Next is question number 7. So what would be the correct answer? Mr. Ravan invested a certain amount for purchase of gold jewelry on 28th March 2005. So Harshada is saying option A. Ishan is also saying option A. Almas is also saying A. Well done. Farhan also saying A. So the correct answer of question number 7 is of course A. So we have to calculate the PGBP income and the business income both. So it's a case of conversion of capital asset into stock in trade. So the chargeability year would be assessment year 25-26. But the conversion has taken place on 8 February 2016. So the transfer year would be 8 February 16. The period of holding would be up to 8 February 2016. So according to it, for the purpose of capital gain, the sale consideration would be the fair market value. The fair market value at the time of conversion would be the sale consideration. So that would be 4 lakh. Now, the cost of acquisition or index cost of acquisition, the cost would be 1 lakh multiplied by the year of transfer. That would be according to 8th February 2016. So it would be 254 upon 113. So this would be 224,778. So the answer would be 175,222. Capital gain. This would be capital. PGBP income would be the sale price less the FMV, what we have taken as sale consideration for the purpose of capital gain chargeability. So the remaining 1 lakh would be your capital gain. Next is question number 8. So what is the correct answer of question number 8? Ishan is saying B. Soumya is also saying B. Very good. Harshada B. Almaz B. Rajbir is also saying B. Anubhav also saying B. Well done. So the correct answer of question number 8 is B. And it's about transfer of asset from a partnership firm to the partner. So in this situation, the sale consideration would be 35 lakh as FMV would be the sale consideration when an asset has been transferred from a partnership firm to the partner. Then we reduce the index cost of acquisition as per normal provision. The cost would be 10 lakh. Transfer year is 363 and purchase is 113. So this would be your cost of acquisition and remaining would be your capital gain. Next, question number 9. What is the correct answer of question number 9? Harshada is saying D. Ishan is saying D. Soumya also saying D. Well done. Almas also saying D. The correct answer is, of course, option number D. The provision says Ram applied for enhanced compensation for his property, which was compulsory acquired by government and received EC of 5 lakh. Index cost of the acquisition of property, etc., was 2 lakh and improvement was 40,000. So calculate the capital gain. So in case of EC, there would not be any cost of acquisition and cost of improvement because that must have already been deducted at the time of calculation of your capital gain on receiving on original compensation. So the correct answer would be 5 lakh. The question number 10 we will discuss today. So I have not given that question to you because it would be these provision regarding question number 10 is going to be discussed today. So this is your homework. Question number 1. And I would like to give you 3 questions of buyback of shares. The special provision. This is also your homework part for our next class. You can take the screenshot of these questions. Question number 11. Homework number 2. This is regarding buyback of shares. Question number 12. That is your homework question number 3. And this is question number 4. They all question number 2, 3, and 4. They all connected to buyback of shares. So please read it carefully and try to solve it. In the next session, we will discuss these questions also. Okay. So now we are continuing the provision, what we were discussing in the last class. And that was section 50, what we have discussed in our last class. That was regarding capital gain in case of depreciable asset. So I've asked you that we will solve a question also. And here is the question for depreciable asset capital gain. The example says, Singhania and Company, a sole proprietorship, owns 6 machines. Put in use for business in March 23, the depreciation on these machines charged at 15%. The WDVs on 1st April 2024 was 8,50,000. 3 of the old machines were sold on 10th June 2024 for 11 lakh. A second-hand plant was bought for 850 on 30th November 2024. You are required to determine the claim of depreciation for the assessment year 25-26. So this must have been the part of PGBP, what the provision you have already gone through. So how to calculate depreciation? These provision you must have gone through under PGBP provision that has already been discussed in these classes. Then we have compute the capital gain liable to tax for assessment year 25-26. And the question says, suppose if Singhania and Company had sold 3 machines in June 24 for 21 lakh rupees. It has been sold for 11 lakh, but they say now supposed these assets have been transferred for 21 lakh rupees, then what would be your depreciation and capital gain? So I believe you can calculate the depreciation yourself, but I am going to help you. I will show how to calculate depreciation in this case. And then we will see how to calculate the capital gain also. The provision says, first of all, we are going to calculate the depreciation. What is the requirement of point number 1? So for the purpose of calculation of depreciation, we have to find out the opening WDV of block of asset that has been given in question on 1st April 2024. It was 8,50,000. New asset purchased and old has been transferred. So we will add the actual cost of asset purchased. And that is in November 24. And the value is again 8,50,000. Clear? So total value of these block of asset is 17 lakh. But out of this 17 lakh, money received for 3 asset transfer. And that is from opening WD. That has been mentioned in the question. That out of these old machines, some asset has been transferred for 11 lakh rupees. So technically, the money received is 11 lakh. So my closing WDV for the purpose of depreciation is 6 lakh rupees. That is a closing WDV on 31st March 25. Now to calculate the depreciation, we have to see, because these assets has been purchased in November 2024. So the time we have used that these assets are less than 180 days. And if asset used for put to use for less than 180 days, then we will claim the depreciation 50% of the normal rate of depreciation, which has been given 15%. But before that, money received. The question specifically says the money received is 11 lakh for the new asset, which has for the old asset, what was earlier in the block. So out of this 11 lakh, 8,50,000 is going to be reduced from the opening block of asset value. So now we do not have any value left, which is from the opening WDV of the block of asset. Out of this 11 lakh, we have used 850 from the opening WDV. The remaining 2.5 lakh is going to be reduced from this asset purchase. Why? Because the block of asset definition is like that. Once an asset comes into the block, its individual identity ceases to exist. So because the question specifically says that the old machine has been sold out. So first of all, we have to reduce the money received out of that value. And if anything balance is left, then we have to reduce that balance out of the other machine value. So now the machine value left is 6 lakh, and you can see it will be equal from this value. It will be always equivalent. So this value and this value will always be same. So now you can see the value left for the purpose of depreciation belongs to these new asset value. So what would be the depreciation rate? The depreciation rate would be 50% of normal rate. The normal rate was, of course, 15%. So the depreciation rate for this would be this value. So my depreciation would be 45,000. Clear? So this is the part of your PGBP, and I believe you must have understood all these concepts because you must have gone through these provision earlier. Now stick to the capital gain provision. The second point was saying calculate the capital gain as we discussed in our last session. How we need to calculate the capital gain? We have to take the sale consideration. The good thing, the capital gain would be always short-term capital gain or capital loss. Can you tell me, as we discussed in our last session, the question, this is the question. So this question relates to which case? Whether whole block of asset has been transferred or whole block of asset has not been transferred. Which is the case? We are going to calculate in point number 2. So according to you, this point number 2 relates to which condition? Whether whole block of asset has been transferred or whole block of asset does not transfer. So somebody answered. Ishan Bisht is saying not been transferred. Very well done. Yes. Whole block of asset not transfer because the question specifically says that the old machine has been, 3 of old machine has been transferred. So when whole block of asset does not transfer, then we can only calculate short-term capital gain. If that is loss, we have to ignore it. So now we will see whether this case belongs to a gain or a loss. And how we are going to find this out? The sale consideration is 11 lakh. So the calculation of capital gain is just opposite, like the depreciation. In depreciation, first of all, we take these things and then we reduce money received. In case of capital gain, we have to take the money received first, and now we are going to reduce these. Opening WDV of block of asset, that is 850. And asset purchased, it is again 850. So you can see there would be 6 lakh short-term capital loss. So which is not allowed. So we will say no capital gain provision apply. Clear? Now the question has been changed. The question third point says, suppose this consideration 11 lakh is not 11 lakh. Suppose this is now, how much it was? 21 lakh. So if it is 21 lakh, now calculate the depreciation as well as capital gain. So again, we are going to calculate the depreciation first. Opening WDV is of course 8,50,000. New asset purchased is of course 8,50,000. So that is 17 lakh. Now questions say money received is 21 lakh. So you must have gone through in the provision of depreciation that we cannot reduce more than the WDV for the purpose of money received provision. So because we received 21 lakh, but we can reduce only maximum 17 lakh. And if there is no value remaining, so there could not be any depreciation in this case. So for the purpose of calculation of depreciation, there must be value as well as asset in the block. So in this question, asset is there because only 3 out of these opening values it has been transferred. So asset is there, assets are there, but value does not here. So because no value, So that's why we cannot claim the depreciation. Now the capital gain part we will see. The sale consideration is now 21 lakh. And of course, opening WDV 850, new asset purchased 850, remaining 4 lakh would be your gain. This is short-term capital gain. So in this point number 3, there would be no depreciation, but there would be always gain in this case. I hope it's clear now. We have the solution also. You can go through the solution of study material. It's a question of your study material, of course. So you can see the block in the first case, the value, the depreciation has been calculated over here. Everything has been explained in detail. Then if the consideration is 21 lakh, then there would be capital gain of 4 lakh. And that would be always short term. Now, next provision is for slump sale. Now, what is the meaning of slump sale? The slump sale says then if you are going to transfer any undertaking, one or more undertaking, one or more unit. Suppose you are having 3 factories. So we are talking about if you are going to transfer one factory, full factory, not the separate asset of a factory. If you are going to transfer separate or individual asset of a factory or any unit or any undertaking, that would be the separate capital gain. Depreciable, if that asset is depreciable, then according to section 50, if it is not a depreciable asset, then as per the other capital gain provision. So we are not talking about that. We are talking about the case in which we are transferring all asset, all liability of a single undertaking, whether one or more undertaking. And the problem is this, we are not taking the consideration individually. Suppose in my factory, there are 15 assets, some depreciable, some non-depreciable. If I'm transferring my unit and I'm taking consideration separately for different asset, then capital gain would be calculated separately. As per normal provision, we have already gone through. But suppose I have decided, no, I am going to transfer this whole factory for a single consideration, for a lump sum consideration. That's why the name comes from slump sale. It's lump sum sale. So lump sum sale means a single consideration. I have said that I am going to transfer my factory for 1 crore 20 lakh rupees. Everything included. All asset, all liability, everything. So that would be constitute slump sale. Understood? So meaning of slump sale under section 242C, it says, it means the transfer of one or more undertaking as a result of the sale for a lump sum consideration. And the important word is without values being assigned to the individual asset and liability. So there would not be any separate consideration for any asset or liability. It would be a lump sum consideration. In such sale, the consideration is fixed for the whole undertaking and will be received by the transferor. Now the problem is this, there could be some depreciable asset. There could be some non-depreciable asset like the land on which factory has been built. So the land would be a non-depreciable asset. But the construction value, the machines, etc., they are depreciable asset. There could be long-term or short-term. Suppose some machines has been purchased 1 year, before 1 year, like after 6 months, we are going to decide to transfer that unit. And some asset could be more than 3-year-old or 5-year or 10 years. So there could be indexation possible if that is non-depreciable and long-term, and there would not be any indexation if that is depreciable asset. So how we are going to calculate the capital gain? And the sale consideration is fixed, the single value. We do not know the separate sale consideration for individual asset. So this kind of question is in the examination or in your study or in your question paper. In that case, we have to apply the provision of slump sale for the purpose of calculation of capital gain. What are the main ingredients? What are the main ingredients for the purpose of calculation of capital gain? the main ingredients is sale consideration and the cost of acquisition or index cost of acquisition and the cost of improvement and index cost of improvement. A very interesting thing is there. We have seen that after the amendment on or after 23rd of July, either your asset would be long term after 12 months or after 24 months. Earlier it was 12 months, 24 months, and some asset was in the format of 36 months. But on or after 23rd of July, the nature of gain would be decided as per 12 months and 24 months for all the asset. But slum sale is still having the old provision of 36 months. So it does not fall in the definition of asset. Slum sale is a separate provision. Its provisions are separate. So in the case of slum sale, when we will call it long term or when we will call it short term, it will not depend upon individual asset and liability. It will depend upon that undertaking, that factory, that unit we are transferring. So if that factory is 36 months more old, then it would be long term. And if that factory or unit is up to 36 months or less, it would be called a short term. So the first problem, the nature of gain is going to be solved and says the period of holding, how we are going to decide if such undertaking is transferred before 36 months from its incorporation, then it would be short term, or if on or after, sorry, not on or after 36 months, up to 36 months, short term, after 36 months, it would become long-term capital asset. So first problem is sorted. So nature of gain or period of holding would be decided upon as per the undertaking. Now sale consideration would be given in the question. So there is no problem. The problem is with cost of acquisition, index cost of acquisition, cost of improvement, index cost of improvement. So it says whether it's short-term case, whether it's long-term case, the net worth of undertaking, the net worth of that undertaking would be treated as cost of acquisition, index cost of acquisition, cost of improvement, index cost of improvement, as the case may be. There is no indexation formula need to apply. Whatever would be the net worth as per the balance sheet, that would be considered as your cost. And if you reduced the net worth from sale consideration, you will get your gain, long term or short term, or there could be loss, long term or short term. No indexation concept need to be applicable. So the net worth of the undertaking or division on the date of transfer shall be the cost of acquisition and cost of improvement. No indexation need to be done. Now the sale consideration is very simple till now, but a provision has been made in this concept also. Now the provision says what would be the deemed value, deemed full value of consideration as per section 50B. Slum sale is a part of section 50B. So it says fair market value of the capital asset as on the date of transfer, calculated in the prescribed manner, shall be deemed to be the full value of the consideration received or accruing as a result of the transfer of such capital asset. So those assets you are transferring, the fair market value of the asset you are transferring would be considered as your deemed full value of consideration. That would be given in the question. So the final provision for the purpose of sale consideration has been, accordingly, the CBDT has prescribed that for the purpose of section 50B22, the FMV of capital asset would be the higher. FMV1 being the FMV of capital asset transferred by way of slum sale, determined on the date of slum sale, and being the fair market value of the consideration, monetary and non-monetary, received or accruing as a result of transfer by way of slum sale. So the asset you are transferring, the FMV of that asset would be the FMV1, and FMV2 would be the market value of the consideration. If you are receiving, suppose, 1 crore rupees for the consideration, 1 crore, and the FMV of the asset you are transferring is 1 crore 10 lakh, then 1 crore 10 lakh would be your sale consideration. Suppose the FMV of the assets are 90 lakh, then 1 crore would be the sale consideration. So we can say in a simple way, the FMV of the asset transfer or the consideration you are receiving, whether in monetary form or non-monetary form, whichever is higher would be your sale consideration for the purpose of capital. The main working to solve this question is to calculation of net worth. How we calculate net worth, that is important. So what is the meaning of net worth, etc.? You must have gone through in accounts provision, the meaning of net worth is exactly the same. Report of a CA is required, which will assure that the value has been calculated correctly. How we calculate the net worth? Let me show you the net worth calculation detail. Then we will solve this question. You can see this is the table of section 50B in a summarized way. Is the undertaking held for more than 36 months? If it is yes, it would be long term. If it is no, it would be short term. The rate of tax we will discuss in part 2 of capital gain from our next session. Now, how we will calculate capital gain? So the provision says we have to take the FMV, and FMV will be higher of FMV1 or FMV2 as we seen in the last provision. Now we need to reduce the net worth, which would be considered as your cost of acquisition and cost of improvement. Now, what is the meaning of net worth? Aggregate value of total asset of the undertaking less value of liabilities of the undertaking appearing in the books of account. How we will take the value of total asset? So it says in case of depreciable asset, we will take the WDV. If they are self-generated, the value should be 0. In case of capital asset where the whole expenses has been allowed under section 35 AD. Do you remember section 35 AD? What it says? The section 35 AD is for specified businesses like hotel, hospital, etc. So if your asset has been claimed deduction under section 35 AD, automatically its book value become nil. In case of other asset, we will take the book value. Clear? Now we will see how to solve this question in the examination. So here is a question, and let me tell you, to solve a question of slum sale, if you are able to calculate the net worth correctly, you are able to solve the question very, very easily. How? We will read this question and then we will solve it. So the example says, this is also from your study material, of course. Mr. A is a proprietor of Akash Enterprises having 2 units. He transferred on 1st April 2024 his unit 1 by way of slum sale for a total consideration of 30 lakhs. So this is your consideration which you received or assessee declared. But the fair market value of capital asset of unit 1 on 1/4/2024 was 30 lakh. So this you can say, this is your FMV 2 and this is FMV 1 as per the formula. So what are the fair market value of asset transfer? That is FMV 1, and whatever consideration you are describing, that is FMV 2. So the higher would be 30 lakh. So that would be my sale consideration in this question. Unit 1 was starting in 2005-06. So that would be long-term capital asset. The expenditure incurred for transfer was 28,000. So that would be considered as expenses on sale. So that would be now 29 lakh 72,000 is my net sale consideration. Now we just need to find out the net worth as per the information given. So if you are able to find out the net worth correctly, you will get full marks. You can see the balance sheet has been given, the liabilities and the assets both has been given for unit 1 and unit 2. There are some information also in this question which says revaluation reserve is created by revising upward the value of the building of unit number 1. So if there is any revaluation reserve that is not going to be considered for the purpose of calculation of net worth, that has been any kind of revaluation reserve need to be removed for the purpose of calculation of your net worth. You can see for the purpose of computation of net worth, the WDV as per section 43(6) has to be considered in the case of depreciable asset. The problem has been solved that the balance sheet value of 3 lakh, that is 9 lakh, represent the WDV of the machinery respectively of unit number 1, because the question says that 3 lakh rupees value has been on account of revaluation reserve. So we have to remove this value for the calculation of net worth of the unit. The second point is building is 12 lakh. So we are considering only 9 lakh after removing revaluation reserve. No individual value of any asset is considered in the transfer deed. Okay. Machinery, there is no other information regarding machinery. So we will include 3 lakh rupees for the purpose of machine. Now debtors value has been given 1 lakh rupees. So we will include debtors value also 1 lakh. And other asset is 1,50,000. But there is an information, point number 3, which says other asset of unit 1, including patents acquired on 1st July 22 for 50,000. So if we remove 50,000 from this, then the value is other asset is 1 lakh, on which no depreciation has been charged yet. So we have to include the patent value also. But after charging depreciation from 1st July 2022-23, then we can take the value of patent. On patent, what is the depreciation rate? Who will tell me the depreciation rate on patent? You must have gone through in PGBB provision. What is the rate of depreciation? Ishan is saying 40. What are you saying, Ishan? No, it's not 40. Tanu is saying, Nidhi is saying 25. Yes, Rajveer also saying 25. Correct. The rate is 25%. So it has been purchased on 1st July. So because it is more than 180 days, so we will apply full rate of depreciation. You can see the calculation of patent value. Cost on July 2022, 50,000. The depreciation for financial year 22-23, 12,500. Balance is 37,500. Depreciation for financial year 23-24 is this one. And the WDV on 1st April 2024 would be 28,125. So we have considered the building value 9 lakh, machinery 3 lakh, debtor value 1 lakh, patent 28,125, and other asset after excluding patent value out of it. So that would be 1,428,125. Now moving on to liability side. Revaluation reserve, we have excluded it from the value of building. Bank loan says 70% is for unit 1. So out of this 20 lakhs, 70% belongs to unit 1. So that means 1,40,000 would be the liability of unit 1. And trade credit says 25% of 1,50,000 is going to be the liability of unit 1. That would be, I guess, 37,500. So these two liabilities need to be removed or reduced. You can see creditors and bank loan. After that, my net worth is 1250625. So as soon as you are able to calculate the correct net worth, your question is solved. So you can see the sale consideration, expense on transfer, your net sale consideration, your net worth we reduced, and this is our long-term capital gain, and that is your answer. I hope it's clear to everyone. So after slum sale, now we are having a special provision in case of capital gain, in case of non-resident. So if a non-resident purchase shares or security of an Indian company, but if he or she purchased that security in foreign currency, the important thing, the special thing is that asset has been purchased in foreign currency. In that situation, निधि इज आस्किंग यूनिट 2 का कुछ नहीं करेंगे सर. निधि हमने सिर्फ यूनिट 1 ट्रांसफर करी है. द क्वेश्चन ने कहा है कि हमने यूनिट 1 ट्रांसफर करी है, तो जब 1 ट्रांसफर करी है सिर्फ, तो उसी का कैपिटल गेन कैलकुलेट करना है. अगर दोनों यूनिट ट्रांसफर की होती तो सेकंड यूनिट का हमें अलग से सेल कंसिडरेशन देता, तब हम उसकी स्लम सेल का कैपिटल गेन कैलकुलेट कर सकते थे. बट इस एग्जांपल में हम कुछ कैलकुलेट नहीं करेंगे. ओके. So computation of capital gain in case of non-resident. In case of non-resident, capital gain from the transfer of shares or debentures. Or debenture in an Indian company. So the important points are the assessee should be a non-resident. The security should be a share or debenture. That must be of an Indian company, and the most important, that has been purchased in foreign currency initially. So suppose Mr. A is a non-resident, he purchased shares or debenture of an Indian company in 2000, suppose 14, and used his foreign currency to purchase these shares. Okay. He used his foreign currency, and out of that foreign currency, he converted that foreign currency into Indian currency and purchased shares. Then at the time of transfer of these shares, suppose now he transferred these shares in 2024. Then we have to calculate the gain also in that foreign currency in which he purchased that shares. So this is the new concept, that if you are a non-resident, if you purchase shares or debenture of an Indian company, initially using foreign currency. So whenever those shares going to be transferred, we have to calculate the capital gain in that foreign currency. Suppose he utilized dollars. So we have to calculate the capital gain also in the dollars. So this is the new concept. How we calculate it? The question says, we have to find out the cost of acquisition. The cost of acquisition need to be calculated by taking average of TTBR and TTSR at the date of acquisition. Now, what is TTBR, TTSR? TTBR stands for telegraphic transfer buying rate. Telegraphic transfer buying rate. And TTSR, of course, telegraphic transfer selling rate. So these rates are from the point of view of RBI. So when I'm saying telegraphic transfer buying rate, so it is the rate on which RBI purchase foreign currency from you. If you want to sell your foreign currency to RBI, so this is the rate on which RBI going to buy foreign currency from you. Understand? And what should be TTSR? This is the RBI selling rate. So if you want to purchase foreign currency, and if you went to the RBI that I need foreign currency, so this would be the rate at which they are going to sell you the foreign currency. And of course, TTSR would always be higher than TTBR. Normal business principle. If you are going to purchase something for 100 rupees, of course, the selling rate would be more than 100 rupees. So if you are having foreign currency, you are going to RBI that please buy it. So maybe they will give you 100 rupees for $1. Suppose it's like this. Okay, of course, if you are giving me $1, we will pay you 100 rupees. So that is buying rate of foreign currency from the point of view of RBI. Now you want to buy, suppose, foreign currency. You went to RBI that I need foreign currency. So they will say, okay, now we are going to charge, suppose, 104 rupees for a dollar. So if you go to sell your dollar, they will give you 100. If you're going to buy the dollars, they will charge, of course, more. So this TTBR, TTSR concept need to be applicable to calculate the capital gain in case of a non-resident. Those are purchasing shared debentures of an Indian company in foreign currency. So we need to calculate the capital gain also in foreign currency. Understood? I believe. We will solve a question, then you will come to know how to solve this. So all the values need to be converted. So the values would be given in Indian currency in the question, but you have to reconvert those value in foreign currency. And for the purpose of conversion, there would be TTBR and TTSR rate. With the help of TTBR and TTSR rate, we can easily convert those Indian value or INR values, sale consideration or cost, into foreign currency value in other currency. We just need to do one thing. We need to find out the average of TTBR, TTSR every time. So if the question says that you utilize 10 lakh rupees for the purchase, and if you want to convert it into foreign currency, so we have to apply the average of TTBR and TTSR. How we need to apply it, we will solve with the help of a question, do not worry. For the purpose of sale consideration or expense on transfer, we again need same thing, average of TTBR, TTSR at the time of transfer. So for the purpose of cost of acquisition, we need average of TTBR, TTSR at the time of purchase. Obvious. If we need to calculate the sale consideration in foreign currency, we need TTBR, TTSR average at the time of sale. Now, capital gain would also going to be calculated in foreign currency. And whatever would be your long-term, short-term capital gain in foreign currency, we again need to convert that capital gain into Indian currency. After calculation of capital gain, finally find out the long-term or short-term, we have to convert that value into Indian currency again. TTBR, TTSR कहाँ है सर मॉड्यूल में? निधि प्लीज ना इस तरह के क्वेश्चन आप क्लास के बीच में ना पूछा करें. मॉड्यूल में है, आप ढूंढेंगे आपको मिल जाएगा. मॉड्यूल में जाके ना सर्च करना, कंट्रोल F मारिए एंड जस्ट सर्च TTBR. You will find out there's special provision. So please do not ask these kind of question. Okay, go open a study material, control F press and then type TTBR. You will find out the provision over there. Okay, so cost of acquisition need to be converted as per average of TTBR, TTSR on the date of acquisition. Sale consideration need to convert it on the date of transfer. Let me show you with the help of an example. Suppose Mr. A non-resident, clear? He utilized dollars. He sent $10,000 to India to purchase shares of an Indian company. Clear? Out of these $10,000, shares has been purchased in Indian company. After some time, he decided to transfer these shares. and suppose the value has been given 10 lakh rupees. Now this is Indian currency, but for the purpose of capital gain, now when we will take the sale consideration, we have to convert this value into dollars, as well as the cost of acquisition, which would be given in the question, that how much amount we have utilized to purchase the shares. Suppose the question says 4 lakh rupees has been utilized to purchase the shares. So we send the dollars, but to purchase this security, out of these $10,000, we purchase security for the cost of acquisition of 4 lakh rupees. So we need to convert this value also in dollars. There is no indexation required. So there would be long term or short term, but indexation not applicable in this case. So after this, our capital gain, whether short term or long term, would also be in this currency. Suppose it comes around $2,000. Suppose, clear? After conversion effect, this is now $2,000. So now this $2,000 capital gain need to reconvert again into Indian currency. And for the purpose of reconversion, we have to multiply it with TTBR. So this would be your final answer for the purpose of question. So if you leave question over here, you will not get full marks. After calculation of capital gain in foreign currency, you have to multiply it with the TTBR. Now tell me, which date TTBR we should use? Which date TTBR? We do not need average of TTBR, TTSR for this purpose. We just need to multiply it with the TTBR. Which date TTBR we should use? Date of purchase or date of sale? It's a very common question. Of course, correct, Ishan, date of transfer. So we will multiply it with the date of transfer, TTBR. Now, how we will calculate average of TTBR and TTSR? In the question, the TTBR and TTSR would be given there. At the time of purchase, TTBR, TTSR would be there. At the time of sale of TTBR, TTSR would be there. Suppose TTBR has been given 91 rupees and TTSR, suppose this is 89 and TTSR is 91. So how we calculate average? TTBR plus TTSR divided by 2. So this you just need to learn, this average formula. TTBR, TTSR value would be there in the question. Do not worry about it. You just need to calculate the average, and it's that simple, that TTBR plus TTSR divided by 2. So whatever average you will get, you have to use this to convert the rupees into dollars or foreign currency. You have to divide the value by using this value. So we are having a solution. Let's see example with the solution, so you would be able to understand the concept more clearly. Okay. So NRI remit $40,000 in India on 16/9/2020. So he just remit. He did not buy the shares on this date. He remit these dollars on this date. The amount used partly in purchasing security in India on 3rd October 2020. So this is the date of purchase, 3rd October 20. For 10,000 share of A Limited at the rate of 12 rupees per share. So 1,20,000 has been utilized to purchase this share on the date of 3 October 2020. 3rd October 20. Clear? These shares are sold at 36 rupees each on 30th March 2025. So this is date of transfer. So we need average of TTBR, TTSR of this date. We need average of TTBR, TTSR or purchase date. Rates are given in question. You can see, to confuse students, the TTBR, TTSR on the date of 16th September also given in question, which has no use. This is just to make you confuse. We just need the TTBR, TTSR at the date of purchase, and these are at the time of transfer. So TTBR is 19, TTSR is 21. So average would be 20, 19 plus 21 divided by 2. This is 44, this is 46. So that would be 45 average. This is this simple. Clear? Now calculate capital gain. So you can see the sale consideration is 3,60,000. Average of TTBR, TTSR 45. So this is $8,000. Less cost of acquisition, indexation not applicable. Nature of asset is long term because period of holding is more than 24 months. 1,20,000 divided by 20. TTBR, TTSR average, we are having $6,000. Now the long-term capital gain is $2,000. We need to reconvert this into Indian rupee. So we will multiply it with the TTBR of selling date, and that is 44 rupees. So that would be our answer, 88,000 rupees. So these are, I guess, question with those are very rare to be asked in the examination, but anything could be asked. What is the tax rate we need to applicable in this case? 10% if it is before 23rd of July and 12.5% on or after it. But we will discuss the rate of tax of all kind of capital gain in part 2 of capital gains. Do not bother about it. Okay. Moving on to our second last provision of capital gain part 1. Now here are a special case. The section 112A. Section 112A talks about a special kind of long-term capital gain arising from transfer of an equity shares or a unit of an equity-oriented fund or a unit of a business trust shall be taxed at the rate of 10% or 12.5% of such gains. The tax on capital gain shall be levied in excess of 1.25 lakh rupees. So if your gain falls under section 112A, there is exemption of 1,25,000. So up to 1,25,000, there is no tax. But if your gain exceed 1,25,000, then that is going to be taxed either at 10% or 12.5%. Let me tell you once again, the rates of tax, how to apply that, this exemption, etc. It's going to be discussed in capital gain part 2. So we're just reading out the provision. We just want to know how to calculate gain as per section 112A. But before that, the section is trying to explain you the rates also. So the rates part we will discuss in detail in part 2, but for time being, we are just reading it. The concessional rate of 10% and 12.5% will be applicable if STT, security transaction tax, has been paid on both acquisition and transfer of such capital assets. So what are these provisions? You will come to know. What are new we are discussing, that is very interesting in this. And you can see, and paid at the time of transfer in case of units of equity-oriented fund or a unit of a business trust. Details of tax rate and benefits under capital gain, part 2 note. So do not bother about these rates, etc. The provisions are from here. This we need to understand. You might remember, there was cost of acquisition chart, what we have discussed earlier. And there was a note which says that in case of shares or bonus shares or equity-oriented fund, there are some specific cost of acquisition special provision that we will discuss on page number 44 of notes. And you can see we were at page number 44 and this is now page number 45. Remember, at the time of cost of acquisition chart, let me show you. This, what I was talking, special provisions for shares. This is the interesting part of income tax. Something is going to be connected later or sooner. So what we were discussing in cost of acquisition part. So that was the provision, that is special provision for cost of acquisition for long-term equity shares, equity-oriented fund, bonus shares acquired, allotted before 1st February 2018 and on which STT has been paid. Refer page 44 from notes part 1. So we are discussing that provision now in detail. So there has been a new concept has been emerged from 1st February 2018. So if any shares or equity oriented fund or units has been acquired before this date, then the cost of acquisition needs to be calculated in different manner. What are these new provision? The new provision to tax the long-term capital gain on arising from transfer of a listed equity shares shall be applicable for all those shares traded which are done on or after April 1st, 2018. To provide an interim relief and to provide an opportunity to the investor to plan their affairs, the investor are given an option to assume the cost of acquisition. Let me tell you, we are just discussing a new cost of acquisition case in case of long-term equity shares, equity-oriented funds, or business trusts, etc. No other asset has been affected. Only these shares, concept, bonus share, etc. we are going to discuss over here, forming part of their portfolio different from the one they have actually paid to acquire them. So what is the concept? Let me show you with the help of a chart. This is the chart. So you will understand it very clearly. So if you are having equity shares on which security transaction tax has been paid on purchase and sale both. So these section 112 special provisions are applicable if you are having equity shares on which security transaction tax has been paid at the time of purchase as well as at the time of sale. And it is also applicable on equity oriented funds. But on equity oriented fund, STT must have been paid on the date of transfer only, not on both purchase and sale. For the purpose of equity shares, this concept will applicable. This cost of acquisition calculation provision would be applicable if STT has been paid at the time of sale and purchase both. And in case of equity oriented fund, if STT has been paid on sale only. Even in that case, these provision would be applicable. So how we will find out the cost of acquisition in case of this asset and in case of this asset? Clear? Whether the equity shares are bonus share, right share, any kind of. So let's say if this is long-term capital asset, they are chargeable to tax under section 1128. So if these equity shares are long-term, then cost of acquisition would be as follows, as we are going to solve it. If these are short-term capital assets, if these equity shares are short-term, then we'll fall under section 111A and tax would be at the rate of 15 or 20%. So what would be the tax rate? Do not bother about it. Just focus on this thing, that if we are having equity shares and equity oriented fund, and if STT has been paid at the time of purchase and sale both, STT has been paid at the time of sale. And if these are long-term capital asset, if these become long-term, then cost of acquisition, special provision we are discussing. All other provision, period of holding, sale consideration would remain the same. Only cost of acquisition need to be calculated as follows. This is for the benefit of assessee. Now, if these kind of long-term equity shares or equity oriented fund transferred up to 31st March 2018. If these kind of shares has been transferred up to 31st March 2018, then these were exempted capital gain. Earlier, there was no capital gain if that has been transferred up to 31st March 18. So because this is an old year, so we do not need to learn this provision, because in our examination, the transfer year would be, of course, 24-25. So this was old provision that if these kind of share has been transferred up to 2018, that would be exempted. So just skip that provision. We are discussing what would be the cost of acquisition now. So if the transfer on or after 1st April 2018 under section 112A, then calculate long-term capital gain without indexation. First of all, even if they are long-term, there would not be any indexation benefit. So if you are transferring equity share on which STT has been paid at the time of purchase and sale both, or if you are transferring equity oriented fund on which STT has been paid at the time of transfer, and if they are long term, then in that case, no indexation, up to 1,25,000 long term exempted, as we have discussed earlier. Now, how to calculate cost of acquisition? It starts from now. So it was saying these would be taxable at this rate, 1,25,000 exemption, etc. These tax rate exemption part would also again discuss in detail in part 2. But now in this case, how we need to calculate the cost of acquisition? So it says, if these shares, which shares? On which STT has been paid, the time of purchase sale, if they are EOF, STT has been paid the time of sale, whether they are bonus share, right share, any kind of equity shares. And if they are purchased before 1st February 2018, this date is very important. If they have purchased before 1st February 2018, then cost of acquisition would be higher off. So now we have to calculate these two things. And the higher value would be your cost of acquisition. First of all, actual cost of acquisition. Actual, whatever you paid to purchase those assets. So whatever is your actual cost of acquisition, that need to be taken. Okay. So the higher of first point, actual cost of acquisition. We will understand these provision with the help of example. I have 5-6 example how to calculate cost of acquisition. So just wait. First of all, we should understand the provision. So for that kind of equity share, long-term equity shares, the cost of acquisition need to be calculated taking actual cost of acquisition, and this value, this actual cost of acquisition value, need to be compared to lower of. We need to compare it, the lower of these two values. FMV on 31st January 18, that would be given in question, or sale consideration. They both must be given in the question. So the lower of these value and the actual cost of acquisition, out of these two, higher would be your cost of acquisition. Suppose your actual cost of acquisition was 2 lakh. That would be in question. The FMV of these security on 31st January 2018, suppose 1,80,000. And the sale consideration, which is given in question, is 2,25,000. So what we need to do? The lower of FMV and sale consideration need to be selected and come here, which is like 180. Now 180 and 2 lakh, whichever is higher, is going to be your cost of acquisition. If these securities purchased on or after 1st February 18, if these have been purchased on or after 1st February 18, then cost of acquisition would be normal purchase price. There is nothing to compare, etc. So what do you think in the examination? Which kind of question would be there? Before 1st February 2018 purchase or on or after 1st February 2018 purchase? What do you think? In the examination, if the question would be there, so that would be for this part before 1st February 18 or that would belongs to this value, 1st February 2018, on or after? Not after, it would be most probability that it would be from saying this, that this security has been purchased before 1st February 18. Because in only in that case, you have to apply these provision. If the question says the asset has been purchased on or after 1st February 18, that would be easy for you. So in my opinion, if the institute, if the examiner wants to know that whether a student has been a deep knowledge of the provision, so he must going to frame a question in which shares have been purchased before 1st February 2018, and they must have belonged to section 112A long-term security. Only in that case, they will be able to find out that the student having the deep knowledge of this provision or does not have the deep knowledge of the provision. We will solve these questions. Do not worry, this provision we will solve with the help of this scenario. We are having 5 questions. So let's take a small break of 10 minutes, and then when we will resume, we will solve this question. So Nisarg ji, can we take a break of 10 minutes? Nisarg ji, are you there? Can we start a break of 10 minutes? Okay, thank you. Okay, welcome back, everyone. I believe you must have your tea, coffee, etc. So we were discussing the provision of section 112A, and I believe that you must be feeling that it is quite complicated. Now let me decode it for you in a simple manner. So the provision says like this. Suppose you are having equity shares or you are having equity oriented funds. Clear? Equity share on which STT has been paid at the time of sale as well as purchase. Clear? And if it is equity oriented fund, then if STT has been paid at the time of sale on. So if these condition says yes, then it would fall under section 112A or 111A. So if these are long term, section 112A talks about it regarding the chargeability of tax. And if these are short term, then going to be taxed as per section 111. So special provisions are going to applicable on these long-term provision. Special cost of acquisition. Clear? And if the answer is no, then no special provision for cost of acquisition applicable. Normal cost of acquisition provision as we discussed in the chart. The normal right share cost of acquisition, bonus share cost of acquisition, ordinary share. That would be applicable. No special cost of acquisition provision apply. Clear? So we are talking about this case. So if our security, our transfer does fall in this category, and if this is long term, then a special cost of provision need to be calculated. And you can see we are just discussing cost of acquisition provision. The rate of taxes, the 1,25,000 exemption, etc. That would all going to be discussed in detail in capital gain chapter 2, part 2. Now, for the purpose of cost of acquisition, now the provision says the cost of acquisition need to be calculated as follows. And now you will see this is simple. The first is actual cost of acquisition as per the provision we discussed as per diagram. That is our actual cost of acquisition as per cost of acquisition chart. That cost need to be taken. This is going to be compared with this value. And this is saying FMV on a specific date that is going to be given in question 31st January 18. Or sale consideration. Whichever is lower you need to take. Sale consideration also been there. FMV would be given in question. So out of these two, whatever is lower, and actual cost of acquisition as we find out according to chart, the higher will be your cost of acquisition. No indexation required. And this will be applicable if you purchase or if shares has been acquired you before 1st February 2018. This whole concept will be applicable only in that case. So this means this would be applicable if these long term has been acquired before 1st February 2018. If these long term has been acquired on or after 1st February 2018, then cost would be as per our chart. Now let me show you how it will impact practically. We are having 5 different cases also from the notes that we will discuss, but let me show you how. Suppose we have allotted bonus shares. Bonus shares allotted before 1st April 2001. Suppose bonus share allotted, 1000 bonus share allotted to an assessee before 1st April 2001. The FMV on 31st January 18 has been given 300 rupees per share. These bonus share has been transferred at the rate 400 each. Suppose on 5th May 2024 at the time of transfer and at the time of purchase, STT paid. So now you can see these bonus shares is fulfilling the condition mentioned above. So these bonus shares are long term. You can see STT has been paid and these are equity. STT has been paid at the time of sale and purchase both. So you can see this kind of case does fall this scenario. So STT paid, these are long term, allotted first before 1st February 2018. So you can see these have been allotted before 1st April 2001. So that means automatically before 1st February 2018. So now this provision would be applicable. And if I'll ask you to calculate the cost of acquisition in this case, then what we need to do? First of all, we have to take the actual cost of acquisition. So what would be the actual cost of acquisition in this case? Who will answer? What would be the actual cost of acquisition in this case? Anyone? Tanu is saying nil. Not nil. If bonus share has been allotted, okay, Anubhav is saying 300. Okay, anyone else? Ishan has given the correct answer actually. In case of bonus shares, what are the provision? In case of bonus shares, if we have allotted before 1/4/2001, then as per chart, if you will remember, the FMV on 1/4/2001 need to be taken as cost of acquisition. So in this question, I have not written the FMV yet. So you cannot find out. You should give me the answer that, sir, FMV on 1/4/21 need to be taken. Suppose the FMV on 1/4/21 is 100 rupees. So now actual cost would be 100 rupees for one share. So for 1000 share, it would be 1 lakh. So actual cost of acquisition of these bonus share would be 1 lakh. Now, as per the provision, we have to compare it with this FMV and sale consideration. So in first point, we have to take the actual cost of acquisition as per chart always. That would be called actual cost of acquisition. Now FMV has been given 300 rupees. So that means 3 lakh rupees. And the sale consideration is 400 rupees. So out of these two, we have to take the lower value. That is mean 3 lakh rupees. And now this 3 lakh need to be compared with actual cost of acquisition, that is 1 lakh. So higher would be your cost of acquisition. So this is for the benefit of assessee. If this provision would not be there, you have to take the actual cost only 1 lakh. But according to this, now you can take the FMV on the 31st January 18 as your cost of acquisition, because the higher need to be taken as a cost of acquisition. No indexation allowed. So this is going to be reduced from your sale consideration, 4 lakh. Gain would be 1 lakh rupees. Understood? Now suppose I have changed this question. Suppose bonus shares allotted on 1st June 2010, FMV on 1/4/2001 was 50 rupees. Clear? 1000 bonus shares was there. Sale at the rate of 1000 each. Suppose on 5th May 2024. STT has been paid on sale and purchase both. FMV on 31st January 18 is suppose 800 each. Again, in this case, you can see that they have been allotted before the 1st February 2018. But if in this case, if I'll take actual cost of acquisition of bonus share as per chart, then what should be the actual cost of acquisition in this case? Ishan is saying correct. Soumya is also absolutely correct. If bonus shares has been allotted on or after 1/4/2001, then cost will remain always nil as per chart. Now the second point, of course, the FMV value, that is 800 each for 1000 share. That means 8 lakh. And 10,000, so that means 10 lakh. Whichever is lower, lower is 8 lakh. So now 8 lakh and nil, whichever is higher, would be your cost of acquisition in this case. So that would be a benefit to you, because if this case was not here, then you have to take the cost of acquisition nil. Clear? Suppose in this case, if I'll say STT has not been paid. Suppose in this case I say STT has not been paid. No STT paid. Then this special provision would not be applicable. And in that case, calculation of cost of acquisition as per chart only. So the cost of acquisition would be in this case would be nil if STT has not been paid, because it does not fall under special provision of section 112A. Understood? So by this way, we have to find out the cost of acquisition. In this case, special provision. We are having some question also that would help you to understand the provision easily. Okay, so these are the scenario. These are all separate cases. Scenario 1. So let me not show you the cost of acquisition. Okay, case 1. Sale consideration has been given in the question 1 lakh, 10 lakh, sorry. Date of sale is 1st April 2024. The notes I uploaded, in that it has been written 1st April 2005 wrongly. So you can make it 2024. It won't affect your answer, but that would be outside I previous year. So the notes I have uploaded, the date was 25 was in place of 24. So sale consideration is 1 lakh. Actual cost 8 lakh that has been given in question. Date of purchase is 1st January 17. So that means it is before 1st February 2018. So if it is before 1st February 18, and we are assuming that on these shares, STT has been paid at the time of sale and purchase both. FMV on 31st January 18 has been given in question, and that is 8,50,000. So you have to tell me what should be the cost of acquisition in this case. As per the provision of section 112A, what should be the cost of acquisition in this example? Let's see, somebody has answered. Almas is saying 8,50,000. Soumya saying 8,50,000. Farhan is also saying 8,15,000. Sahil is saying 850. Rajveer is also saying 850. Well done. So you can see when we read the provision, what has been made by the government, we feel it quite complicated. But when you start applying those provisions in numerical way, you will feel that is not that complicated. Look how simple it is. Actual cost of acquisition, you have to take it from chart. If it is not given like this, we have to think about the chart provision and we have to take it from according to the chart concept. Okay. So this is my actual cost of acquisition. Now we have to compare with these two price, FMV and sale consideration. And we need lower. So out of this 10 lakh and 850, lower would be 850. Then lower need to be compared with this actual cost of acquisition. Higher would be my cost of acquisition. So in this case, my cost of acquisition would be 8,50,000. Absolutely correct. Well done, students. Second case. Again, always check the date first. Okay. So in this case, if you will see, again, you will apply the concept. This 10 lakh or 750, whichever is lower. The lower is 750. Now 750 need to be compared with actual cost and it's 8 lakh. So higher we need to take. So what is higher? 8 lakh. So in this case, the cost of acquisition would be 8 lakh. Well done, everybody. You all are giving me the correct answer. Appreciate it. In the third case, apply the provision and let me know what would be the cost of acquisition. Actual cost is 8 lakh. Now 10 lakh and 9 lakh, whichever is lower is 9. And we have to compare 9 and 8. So what would be my cost of acquisition? 9 lakh would be my cost of acquisition. Well done. Very nice. Next. Scenario 4. Now we have to see 10 lakh and 11 lakh. The lower would be 10 lakh and 10 lakh and 8 lakh. So that would be my 10 lakh would be my cost of acquisition in this case. Everybody, okay? Well done. Now last scenario. Scenario 5. What would be my cost of acquisition? Rajveer is saying 8. Julie is saying nil. Almas is saying 8. Anubhav is saying 8. Sunil Kumar is saying 8. So Sunil Kumar, why it is 8 lakh? We should take like 10 and 11. Lower is 10. And 10 and 8. Higher is 10. Why it's not 10 lakh? Nidhi is saying 10 lakh. Very good. Correct. In this scenario, the date of purchase is on or after 1st February 2018. So if date is purchased is after February, then a special provision would not apply. That chart cost of acquisition would be my cost of acquisition. You do not need to compare it into with anyone else. In starting 4 scenario, what was happening? The purchase date was before 1st February 2018. That is why it is very important to check in the question first of all, whether the date is before 1st February 2018 or on or after 1st February 18. If it is on or after 1st February 18, then you just need to take the chart cost of acquisition for the purpose of calculation. You can see the solution is here. Deemed cost of acquisition, you can see 850, 8 lakh, 9 lakh, 10 lakh, and in this case, 8 lakh only. Why? Because it is on or after 1st February 18. Then we have capital gain, sale consideration, minus K cost. So in this case, 150, in this case, 2 lakh, in this case, 1 lakh, in this case, nil, because sale consideration and cost is equal. In this case, 2 lakh. Up to 1,25,000 was exemption. So that we will discuss later also, but we apply the exemption. After exemption, 25,000, 75,000, and 75,000 would be our capital gain. I hope now it is clear that how to calculate cost of acquisition in this special case. Remember, there are certain conditions you have to kept in your mind. This is applicable on equity shares and equity oriented fund. First condition. If it is equity shares, STT need to be paid on purchase and transfer both. In this case, only transfer. If it is long term, section 112A concept will be applicable. If this is short term, 111A concept would be applicable. If it is long term only, then a special cost of provision need to be applied. And that would be applicable if it is allotted before 1st February 2018. So these three things you should kept in your mind for the applicability of these provision. If these condition does not fulfill, like if STT has not been paid, then normal cost of acquisition as per chart need to be applicable. If this is short term, then again this cost of acquisition concept does not apply. If that is allotted on or after 1st February 18, again in that scenario, we do not need to calculate a special cost of acquisition. Normal cost of acquisition would be applicable. Okay. So that was the case. You can go through with the provision. Now we are moving on to our last section of part 1. And I believe that you must have gone through with the provision of this section in PGBP also. The section 50 say we are having 3 sections over here. Section 50C, section 50CA and 50D. So these are capital gain proper section. We will discuss this in capital gain in this topic. But section 50C is exactly same as per section 43CA of PGBP head. Can anyone explain me what is section 43CA was in PGBP head? If somebody wants to explain me in short, I would be really happy. I would ask the technical team to unmute you if you want to explain me in short that what exactly section 40CA talks about. Rajveer is saying the value of building will not exceed stamp duty. Yes, it was like that. But I believe that because you must have taken those lectures around about 15 or 20 days before, so might not be that strong, or you might not be able to recall those provision right now. But section 50C exactly talks about section 43CA of PGBP. Section 43CA of PGBP said that if you are having immovable property, and if you want to transfer that immovable property, then sale consideration would be taken as per section 43CA. Correct? The sale consideration would be derived as per section 43CA if you transfer your stock and if that is an immovable property. Now section 50C exactly copying those provision, and it says if you are transferring a capital asset and if that capital asset is an immovable property, then sale consideration for that property need to be according to section 50C. Same examples are also in this chapter, which you must have tried in PGBP topic. Exactly same. So there is nothing new in section 50C. So the provision I'm going to summarize of section 50C in short, because I believe you must have gone through in detail. And the provision of section 50C says, if you transfer an immovable property, so that means we are talking about land or building or both. Okay. Then sale consideration would be as per section 50C. We have to find out as per section 50C. And it says, if your stamp duty value exceeding 110% of consideration. If your stamp duty value is 1, if your stamp duty value exceed 110% of your consideration, which is declared by you, then your sale consideration would be stamp duty value. As simple as that. Clear? If your stamp duty value does not exceed or equal to 110% of consideration you declared, then sale consideration would be the consideration you declare. So there would be two scenarios. If your stamp duty value is exceeding 110% of consideration, then sale consideration would be your stamp duty value. And if it does not so, then sale consideration would be your consideration. Suppose your stamp duty value is 50 lakh and your consideration is 40 lakh. You are saying I have transferred my immovable property for 40 lakh. But the stamp duty value is 50 lakh rupees. So 110% of consideration would be 44 lakh. And your 50 lakh is exceeding 110% of your consideration, which would be 44 lakh. So in that case, what would be the sale consideration for the purpose of capital gain? 50 lakh. Suppose the stamp duty value is 50 lakh and your consideration is, suppose, 48 lakh. Now 110% would be 52.8 lakhs. So now your stamp duty value does not exceed 110% of consideration. So in this case, your sale consideration would be 48 lakhs. I hope it's clear that there is the same provision in respect of PGBP you must have been gone through. Clear? Now, the provision says on concept, different concept. And it says, suppose the fair market value is 50 lakh. And the real consideration, generally what happens, we get the consideration which is actual the fair market value. Stamp duty value can be more or less than, generally it is lower than the fair market value. But if you are going to transfer your property practically, so you will get the fair market value of that property as a consideration. But suppose a problem arises, that means suppose the fair market value is 50 lakh. But the stamp duty value, which is declared by government of that area, is 60 lakh. So there can be some area in which this kind of scenario can be there, that assessee will actually getting consideration. Real consideration is 50 lakh. Practically, the market value has been decreased, suppose due to some infrastructure non-facility, due to some bad road or bad community, or suppose there are wine shops nearby. So due to that, the fair market value of any property, suppose decrease. Earlier it was 60, but now suppose it's 50. But stamp duty value does not decrease. Suppose this is the real case, that actually I am receiving 50 lakh because the market value is 50 lakh, but stamp duty value is 60. So there would be a problem for assessee. If we apply the normal scenario as per case A, suppose this is case B. Case B is for those cases in which real consideration, the real market value is lower than the stamp duty value. So if we apply the normal provision, so we will take the sale consideration 60 lakh because it is exceeding 110% of consideration. So assessee will say this is unfair. When I am actually receiving 50 lakh rupees, the market value, in this case, the market value is higher, but assessee is declaring consideration less than market value. So this case is there. But if case B applicable, when in the question it says that market value is less than the stamp duty value in real, so that would be really injustice to the assessee, that if suppose I am receiving only 50 lakh, I have to pay tax according to 60 lakh. Suppose the real consideration due to any reason is 40 lakh, but stamp duty value did not decrease, it's 60 lakh. So you might need to pay tax on 60 lakh if this case was not there. So for those kind of cases in which fair market value is less than the stamp duty value, so in that scenario, assessee request to the department that this is not the real value, my FMV is less than the stamp duty value. So in that case, department can refer the case to valuation office. Department will ask the valuation officer that you go and find out the real value of that property. Is the assessee saying correct? The real value is exactly 50. So there would be two cases. The first case, the FMV is exceeding stamp duty value. Suppose assessee was wrong. Department says that no, FMV is exceeding 60 stamp duty value. Suppose the FMV is now 65 lakh. In this case, valuation officer says that according to me, the value is 65 lakh. The FMV assessee was saying 50, but according to me, it's 65. So in this case, sale consideration would be stamp duty value. That would be 60 lakh. It's not 65 lakh. 60 lakh would be the sale consideration for the purpose of capital. And suppose the valuation officer says, yes, FMV is less than stamp duty value. In that case, sale consideration would become the valuation officer value. Suppose it says that the FMV is suppose 50 or 49 lakh. In that case, 49 lakh would be the sale consideration. If valuation officer says it's 50, we will take 50. If he will say 55, we have to take the 55 case. Now the other case, suppose in any case, the stamp duty value revised by the court. In any appeal or in any case, stamp duty value has been revised, then we have to take the revised value for the purpose of capital gain calculation. So for the purpose of examination, if this is not the case in which FMV is less than stamp duty value. So if FMV is less than stamp duty value, then there will be information in the question that the case has been referred to the valuation officer. Then if he says that the fair market value exceeds the stamp duty value, you will take the stamp duty value as the sale consideration. And if says no, FMV does not exceed the stamp duty value, then the value as defined by the valuation officer would be taken as sale consideration. I hope it's clear now. Back to the provision. In case of section 50C, there was also a provision which says that stamp duty value either we need to take at the time of registry, transfer deed, or at the time of agreement has been done. If the payment of advance has been taken via account pay check, IMTS, RTGS, etc. at the time of agreement, then we will take the stamp duty value at the time of agreement. And if the payment does not received by any of these mode, then we will take the stamp duty value for comparison at the time of transfer or the registry has been done. So these provision you must have gone through with the PGBP also. I have just recalled those provision. You can go through with this concept. If there is any problem, we can discuss it later. We are having example also. You can go through with examples. If there is any issue, I can take those example or those query in the next session. The point 2 is regarding those cases in which FMV is less than stamp duty value. So you can see the provision says, if the assessing officer refers the valuation to a valuation officer, when it will happen? When assessee will say that the stamp duty value is higher than the FMV. So I need to pay extra tax on the sale consideration when I am not receiving that sale consideration. So it would be unjustified upon me. So in that situation, assessing officer can ask the valuation officer to value that property. On the assessee's claim that the stamp duty value exceed the FM. In that case, there would be two situations. If valuation by valuation officer is exceeding stamp duty value. So valuation officer says that according to my value, the stamp duty value is not less, my value is more than the stamp duty value. So technically, his value is just like that, FMV or valuation officer value. We can say the valuation officer value exceed the stamp duty value. If this is the first case, in our case, suppose the stamp duty value was 50 lakh. Assessee was saying FMV is 40 lakh. Now valuation officer says my value is suppose 55 lakh. In that case, stamp duty value would become my sale consideration, not the value decided by the valuation officer. Okay. If valuation officer says if my valuation by valuation officer is less than stamp duty value. Now suppose the valuation officer says the value is 46 lakh. In that case, the value decided by the valuation officer would become sale consideration. So in this case, it would be 50 lakh, but in this case, it would be 46 lakh. Okay. If the stamp duty value has been adopted as full value of consideration and subsequently the value is revised. So in those cases, when you take sale consideration as stamp duty value, and if this stamp duty value has been revised due to any appeal or etc., then the revised stamp duty value will become the sale consideration. Now 50CA is a new section that you must have not been gone through in PGBP, and those are for unquoted shares. That means unlisted shares. So if there are unlisted shares and the sale consideration, you are receiving the sale, you are declaring the consideration. The consideration declared by you is less than the fair market value. In that case, we will take the sale consideration as fair market value. So if these are unlisted share, you said the consideration is 10 lakh rupees. I have transferred those shares for 10 lakh. But the market value suppose is 12 lakh rupees. Then for the purpose of capital gain, we will take 12 lakh rupees as sale consideration. If consideration received or accruing as a result of transfer is less than the FMV of such shares, determined in prescribed manner, the provision of this section would not, however, be applicable to any consideration received or accruing as a result of transfer by subject to the person and subject to such condition. So in that case, what would be my sale consideration? FMV of such share as determined prescribed is going to be your sale consideration. Last section, section 50D, it says any capital asset where the consideration received or accruing as a result of the transfer of a capital asset by an assessee is not ascertainable or cannot be determined. In that case, FMV will be treated as the sale consideration. So if there is any consideration for which we are not able to calculate the value of that sale consideration, then we will take the FMV of the asset at the time of transfer as your sale consideration. The valuation rule prescribed 11 UA for valuation of unquoted equity shares would be dealt at final level. So in our level, FMV for unquoted shares, unlisted share would be in the question only. That was part one. And as I always say, revise twice. That's my advice to make you wise. Part two, we will also discuss. We have time with ourselves. So if you have any query, you can ask. Krishan is asking, sir, if valuation by valuation officer is less than FMV, then FMV sale consideration. No. If the valuation done by a valuation officer and if the value does not exceed the stamp duty value, the valuation officer value is less than the stamp duty value, then valuation officer value would be treated as sale consideration. Okay. ECS means electronic clearance like IMPS, RTGS, etc. Okay. Bank transfer. So we can continue with the second part also. So part one was discussing about how to calculate the capital gain. So part one was all about how to calculate capital gain. Like we have to, first of all, we have to see the period of holding. whether it's a long term, short term. Then we have to find out the sale consideration accordingly. Then we have to see whether cost of acquisition or index cost of acquisition need to be applicable. Then there is cost of improvement or index cost of improvement need to be done accordingly. Then we will get our long-term, short-term gain or loss. But capital gain does not end here. We are having other provisions also. Like there are certain exemptions in capital gain also. Okay. But if valuation officer value less than SDV and also less than FMV, then look, the provisions are very clear, Ishan. It says, you can see, the provision says if valuation by valuation officer is more than stamp duty value, then we have to take the stamp duty value. Clear? But if valuation by valuation officer is less than stamp duty value, like we are not going to consider FMV anywhere in this scenario. If case has been referred, if case has been referred to the valuation officer, then FMV does not have any role. If the valuation officer says that my value is less than the stamp duty value, in that case, the valuation done by valuation officer value, that would become automatically sale consideration. Whether it's more than FMV, whether it's less than FMV, it does not matter at all. Okay. With Tanu, sir, amount not transferred through online transaction. Tanu, this topic of section 50C, as I have told you earlier, that has been exactly the copy of section 43CA of PGBP. And I believe that must have been discussed by the faculty in PGBP. But again, let me tell you, if the amount, if the advance received at the time of agreement has not been received via specified modes like account pay, check, etc., which has been mentioned over here, IMPS, UPI, RTGS, NEFT, ECS, check, or bank, account pay, etc. If the advance has been received in cash, suppose, then the stamp duty value on the date of agreement will not be considered for the purpose of section 50C, but the stamp duty value on the date of registry, the transfer deed executed, need to be taken for the purpose of calculation. So that would be a risk for you, because suppose agreement date is today and registry you are decided that we will do after 6 months. And between that 6 months, if stamp duty has been increased, then your consideration would be increased automatically. So it would be beneficial to the assessee that he will pay some amount via account pay, check, etc. So the stamp duty value would be considered at the time of register agreement what you are doing. Okay. So according to, if somebody wants to ask something, who is that person? Somebody has raised hand. It's gone down. Miss Harshada is asking, sir, can you please explain this point of asset used for scientific research in PGBP is sold, transferred, then WDV cost in PGBP and excess amount is capital gain. So I believe, Harshada, that must have been taken when PGBP provision might be discussing with you. But I am having a question and solution also related to your query. So in that scenario, it has been written that if the consideration, whatever you are receiving at the time of transfer of those scientific research asset exceed the cost of acquisition, only in that scenario, you would be able to calculate the capital gain. How it's going to be calculated, that's not the part of course, capital gain part, because it must have been told in TGBP, but I will explain it with the help of an example. Please remind me at the starting of our next session. So I will provide you the solution also with the question, and we can discuss this topic. It won't take more than 5 or 6 minutes. Okay. Mohammed Farhan is saying section, sir, please explain section 50D again. What you want to understand in case of section 50D, Mr. Farhan? Okay, 50D says if there is any scenario in which you won't be able to find out the sale consideration, because it is not ascertainable or cannot be determined, then you can take the FMV of that asset as the consideration at the time of transfer. Let me tell you with the help of an example. It's a very good question asked by Farhan. Nobody else asked me. Suppose section 50D example. So I'm just trying to tell you when there would be a cases when the sale consideration would be unascertainable, that you are not able to ascertain the value. Suppose there is Mr. A who bought a painting. He purchased a painting, antique painting, okay, from some famous actor. He paid 5 lakh rupees for purchasing this painting. And on suppose 10th May 2015, he purchased that painting. Clear? Suppose a famous actor, like suppose Mr. Bachchan, he was searching for this specific painting, and Mr. Bachchan comes to know that this painting is Mr. A. So he called Mr. A that I want to buy this painting and I will pay whatever is the market value of this painting or whatever you will charge. Now, Mr. A was a big fan of Mr. Bachchan, very big fan. So he was very surprised and happy that Mr. Bachchan actually asked me to purchase this painting. So Mr. A say, I will not take money, sir. You can do just one thing, that please come to my house to collect this painting. My consideration is this. This is my consideration, that you have to come to my house and have a cup of tea with me. That's it. This is my consideration. I will not take money. So you can see, and suppose Mr. Bachchan comes to his house, having a cup of tea with him, and take this painting from Mr. A. Now, can you tell me, is this a gift? Is this a gift or not? Priyanshi is saying painting is done by brush, wet, paint color, drawing is done by pencil, sketch. Good one. I guess you must have Googled it. Okay, so whether it's a gift or not, Nidhi is saying yes, Rajveer is saying no, Pooja is saying yes, Rajveer is saying again no, Divya is saying no, Sandeep is saying yes, Soumya is saying no. Correct. It is not a gift, because in gift there would not be any consideration. But you can see in this case, there is a consideration. And the consideration is having a tea with Mr. Bachchan at your own house. So now you understand there is consideration. So we are having consideration, tea. But a cost of tea might be maximum 20 rupees or 50 rupees. So is it the tea cost what is important, or it is the importance of tea with Mr. Bachchan for Mr. A? So what is important? It's only a tea consideration, or it's having a tea with Mr. Bachchan is the consideration. What is exactly the consideration? The consideration is having a tea with Mr. Bachchan. So now he is having that kind of feeling. What he must be thinking, that I won't need money for this painting, but I want to have a tea with Mr. Bachchan. That is more valuable than the money what I can get after selling this property. So now this is kind of a consideration which is called unascertained consideration. Why? Let me tell you again. Because he's a fan of Mr. Bachchan, a big fan. So having tea with Mr. Bachchan is a very big thing for Mr. A. But again, having same tea with Mr. Bachchan by any other politician or any other co-star or any of his family member, does it having the same value as it is having with Mr. A? No. Because Mr. A is a big fan of Mr. Bachchan, so that tea with Mr. Bachchan is having a different value in comparison to having tea with Mr. Bachchan with any other politician, TV star, co-star, family member, etc. So they might not feel it is that big deal, but from the point of view of Mr. A, it is that big deal. So you can see now this consideration would be vary from the point of view of different person. So suppose for Mr. A, it is very big thing. Maybe from point of view of Mr. B, who is not that much a fan of Mr. Bachchan, that won't be that big thing for Mr. B or C or D. So now this kind of consideration is called unascertained consideration, because the value, there is no real value. The value depends upon the person who is receiving it. So now in this case, we cannot take the T value 50 rupees as a consideration. So how we will find out the value? So in this case, we cannot find out the FMV of this T consideration anyhow, because it will vary from person to person. So for that purpose, section 50D says, if this kind of scenario arise in which you do not have any kind of certain value, because the value could be changed according to the person, then in that case, the asset you have transferred, the painting you have transferred, so that must have a FMV on this date. The FMV at the time of transfer. Suppose the market value of this painting, suppose at that point of time is 8 lakh. So we will consider that 8 lakh rupees as the sale consideration. We are having cost 5 lakh, indexation, etc. Whatever need to be applied, need to be applied. So in those scenario, the uncertain consideration case would emerge. And in that case, because we cannot certain a single consideration, it will change according to the persons. So that might be a problem for us. So we will take the fair market value of that painting at the time of transfer. Like, let me tell you a practical case. When the IPL happened, I guess the IPL 1 or 2, there was a stand book by Shah Rukh Khan. In that stand, there was 40 seating capacity, 40. And Shah Rukh Khan and his family member watch IPL matches with that stand. And the ticket for that stand is, I guess, 2 lakh rupees for an outsider. So if you want to watch the match of IPL in that stand in which Shah Rukh Khan and family members are sitting, so the costing was 2 lakh rupees. I am a big fan of Shah Rukh Khan. So suppose what happened? No, I did not watch it from stand. I watched from at home because 2 lakh is a big amount. So, but actually there are some fans who purchase the ticket. So watching the same IPL match with the other seat of the same stadium, or watching the IPL match from home, the same thing. But for those person, paying 2 lakh rupees was the consideration they are ready to pay, because the thing value for them is 2 lakh rupees, not watching IPL, but IPL watching with Shah Rukh Khan. So these kind of values varies from person to person. So now you understand the section 50D. Clear? So when there is a case of section 50D, you understand when these kind of cases need to be applied. Yes, FMV means market value. Okay, good. Any other queries, students? Because now I think that exemption part we should start in next session. But if you want to ask anything, you can ask. Let me tell you a small story before that. Like eagle, you all know the eagle. So eagle की generally जो age होती है वो होती है 60 years, for 50 to 60 years की life होती है. But after 30 years what happens? जो ईगल होता है उसके जो बीक होती है उसकी जो वो फोल्ड होना शुरू हो जाती है, वो खराब हो जाती है. उसके जो नाखून होते हैं पैरों के वो भी खराब होना शुरू हो जाते हैं, और जो उसके फेदर्स होते हैं, पंख, वो इतने हैवी हो जाते हैं आफ्टर 30 years दैट वो अच्छी तरह से फ्लाई नहीं कर सकते. तो मैक्सिमम ईगल्स उस एज के बाद शिकार नहीं कर पाते, हंट नहीं कर पाते, तो दे डाई। बट जो बहुत ही स्ट्रांग विल वाला ईगल होता है, वो सिचुएशन में कोई जगह जाता है, बहुत जगह, ऊंची जगह, जो सबसे ऊंची जगह माउंटेन होता है, वहां पहुंचता है, और कंटिन्यूसली अपनी जो बीक होती है उसको, वहां की जो स्टोन होते हैं उस पर मारता रहता है। और एक टाइम के बाद वो बीक उसकी टूट जाती है, बहुत पेन होता है उसको, वेरी, इट्स अ वेरी वेरी पेनफुल प्रोसेस। बट उसको फिर उसके बाद नई बीक आती है। इवन आफ्टर, उसके जो नेल्स होते हैं वो, उनको भी वहां उस स्टोन्स पे घिसता है, टूट जाते हैं, नए वाले आते हैं बिल्कुल फ्रेश। और जो फेदर्स हैं उसको, वो उसको अपने नेल से और अपनी बीक से एक एक कर कर उन्हें तोड़ता है खुद से। This is kind of self-destruction mode, and it's so painful that you can imagine that how painful it would be that somebody is actually, वो अपने ही feathers को, nails को and beak को तोड़ता है। But what happened after certain time, like 6 months or after 1 year, he will have new beak, new nails, and new feathers, and he will be a new eagle. और उसके बाद वो next 30 year फिर से as a king life जीता। So I'm just trying to tell you that for the purpose of achieving anything in your life, which is important, you have to suffer from pain. Pain does not mean that eagle kind of pain. Like sacrifice you have to do. You have to focus whatever you need to get it. So if you will feel pain in starting that study, बहुत difficult हो रही है, नहीं होगा. So that would not be easy. So you have to be very focused. Please believe that चाहे कुछ भी हो जाए, you have to complete your goals, you have to revise your provision, you have to complete your course at a certain point of time, and there's a continuous revision should be there with the practical problems also. You have to go with mock test paper, RTP, previous year examinations question, that will really make your preparation very strong. So like the eagle needs to sacrifice, we all have to sacrifice to achieve any goal in our life which is important. Okay, so any other queries, friends? But I really feel bad today because in the initial starting of the class, when I asked that somebody needs to summarize the provision, there was no one there. You should understand how ICAI and BOS and faculties and coordinators, they are working so hard to provide you these lectures. They are providing you the best faculties, notes, classes. You are having saransh in your study books, charts, diagram, everything. And you are getting it all free. Behind this things, there are a lot of hard work done by our technicians, coordinators, everyone. And you should be actually have that kind of sincerity that if a faculty is already told you that we are going to ask someone for a summary, then you have to be there. At least anyone should try. Why you are escaping yourself? This is a problem with this kind of student, that why do you hesitate? You have to come. Yes, sir, I am going to explain. Either at least tell me, somebody should tell me, sir, I can explain only one section. That would be enough for me. Yes, sir, I am only know how to calculate depreciation, so I can give you that summary of depreciation. It would be enough. If you will take one section, you are having notes in front of you, but there was no one at that time there. That was really, really bad experience I have. First time it happened. So definitely I'll ask each one of you, leave that hesitations. Just try, come forward and take the responsibility. Harshada is saying, I joined late, sir, otherwise could have. So you should be on time, Harshada. You know the class timing, and I believe that next time it won't happen. So please you try to summarize the provision in the next class also. Please somebody comes to forward, and if there is no one is there, so at least someone should come and say, sir, I am going to explain one or two sections only. So there is always something is better than nothing. So we will all, the faculties feel really happy when you interact with us, when you understand, when you react what we ask you to do. Okay. So is there any query? Please. Yes, you can explain in Hindi, English, and any more. Hindi, English only I know, of course. So either English or Hindi, you can summarize the provision. It does not matter. Okay. Tanu, you can also explain me in Hindi. Anyone can do that. So I guess there is no more queries from any one of you. So we will take our next session with our capital gain part 2. Okay. So have a good night. All of you, please study hard. So Nisa, can we close the session? Nisarg, are you there? So we can close the session, Nisarg.